Good morning and welcome back to Almus Market Mornings. The annual inflation in the US fell to 2.7% in November, making it the lowest print since early 2021. And the longest government shutdown prevented the Bureau of Labor Statistics from collecting much of the October price data. That not only limited their ability to determine the month over month changes for the broader measure of inflation, but some of the economists also noted that it is likely impacted the November annual figures as well. After the print, the S&P opened higher while treasury yields remained lower and the dollar fell after the report. And also, it's only a matter of time before we receive the BOJ's interest rate decision in the morning. Good morning, Jayaram sir. Do you think the CPI report will sway the Fed policymakers who remain divided on the course of the interest rates next year? And also, how do you see the yen moving today in the day after the Bank of Japan's meeting?
Good morning, Ishan. Yes, yeah, I think this CPA number was definitely on the face of it, it was a surprise, falling quite a bit on both the core and the headline number. And so that actually, obviously, there's a knee-jerk reaction on that, towards the lower side for the yields and also for the dollar. But on re-look, market is somewhat, skeptical about the actual reliability on the data because of the extended government shutdown. The possibly even the hawks would say that it is unreliable and it will cast an even a larger political shadow also, because at the same time, Mr. Trump will say that the inflation is falling and the rates have to be cut deeper. But we should also recall that even Powell had said that we should be cautious about the analyzing the upcoming data. So similar views have been expressed about the employment data that was published on Tuesday as well. So I think apart from knee-jerk reaction, market wants to wait for the actual data for December, which will come in January, and that will be the full proper, survey data that we will get for both employment as well as the CPI numbers. And I think till then the market will not come to any definite conclusion. Despite that, of course, the CME's FedWatch tool has actually shown increased chances of a rate cut in March by the Fed, and this was much lower earlier. And of course, the Jan meeting is continuing to show no change in the rate. Obviously, a lot of things are going to happen between now and the Fed meeting in January because of we'll have some good reliable data on the economy, as well as we will probably have a better idea on who is going to succeed Powell for the chairmanship of the Fed board. Yeah, apart from the inflation data, we also had manufacturing, Philly Fed manufacturing survey data yesterday, and that showed again, a big decline still continue to be in the negative territory also. So there is a concern that the manufacturing activity in the US continue to be, downbeat. In fact, the looking ahead also, the survey shows that index is going falling even more, and our new orders are likely to be down, and future shipments are also showing decline. So overall, manufacturing sector has been on the downward shift or in the contraction territory for 31 months now. So if you take the weaker employment number and CPI on the lower side, along with the weak employment, so weaker manufacturing, as reliable, and if they are confirmed by the future data as well, then we should expect Fed to get more dovish on the rates, and of course, then even the dollar will come under more pressure. Yes, of course, yesterday we had quite a few rate decisions by the central banks as well. So we had the rate decision by Bank of England first, and they cut rate by 0.25%. But the message was not as dovish as one would have expected. First of all, the rate decision was also by a slim majority of 5 to 4. which means there are four people actually opposed a move on the rate. And bank also said that upside risk to inflation is looks less pronounced, but future decisions would be a closer call. So market actually took that as a slightly more less dovish message, and because of that, we saw actually the gilt yields rose, and also the sterling also was stable against the dollar and stronger against the euro. Then, of course, we had the ECB meeting, who kept the rates as expected, but their stance is now more open. Having kept the rates steady for 6 months, they're sending a signal that it would need a severe downward shift in the inflation or growth to get to the central bank into cutting the rate. So she actually, Lagarde's statement actually somewhat offset the bullish comment given by Isabel Schnabel some days back when they said that the ECB's next move could be a hike. So now the market is more on the neutral side as far as the euro's rates are concerned. But the euro dollar saw another retreat towards 1.17, a failed attempt to go towards 1.18 once again, and more of a flow driven market. So there is no definite conclusions that we can see as far as the euro's current trend is concerned. Then yes, the most important meeting among all the central banks today is the Bank of Japan rate decision. It is tilted towards a hike, no doubt. If you even taking into account today's inflation number that came lower both on the headline and the core, just by 0.1%, but the inflation number is still well above the target of 2% for Japan. And other data from Japan has shown that the machinery orders have been the rising, and even the exports have gone up. Trade balance has shown a healthy surplus. Not much of negative that has been seen in the economy, and therefore I think their decision of hike by 0.25% by Bank of Japan should be very much on the cards. And of course, as usual, we look at to their statements accompanying the policy, as well as the Bank of Japan governor's statements, which will come later in the day in his press conference. As far as yen is concerned, see, I think all the markets in Japan, be it the Nikkei or the JGBs or the yen, have for long now been expecting a rate hike by Japan. So I don't think a major yen strength should be seen after this decision, nor for a rise in the JGB. It's because it's already risen quite a bit this year. And Nikkei has also had a correction. So I don't see a major reaction to the decision today. Market will try to assess what they will do going forward. Therefore, the yen's move can actually be on the lower side, which means the dollar yen can go up. This is because even with today's expected hike, Japanese rates are going to be the second lowest among the major countries. Switzerland, of course, has a 0% interest rate. So I think if you enter the new year with another, central bank offering rates at 0.75%, US, around 3.5%, and many other countries also around the same level, and many EM countries having a higher rate of interest, I think the carry trade is likely to set to continue. So I feel the dollar yen will still move in the range between 154 and 159. Of course, closer to 160, one can expect intervention. This is, of course, subject to a broad dollar direction, which will emerge in the new year. Yes, on the domestic side, the rupee has been in a kind of post-operative ward after a major operation by RBI, and it is under observance to see if it is stabilizing or shows further vulnerability. And there is still some after effects of the big intervention that RBI did on Wednesday, and that is because the market is still long of the dollars, and people are using the upticks towards the 90-40, 90-30 to bail out of their long positions, even as we move towards the year end. And yes, it's probably a period of calmness for the next 10 days or so before a possible another storm. but that is something which we have to wait and see, because this also gives the time for policymakers to strategize their actions, or some policy to address the weakness in the market, because we are not only seeing the weakness in the currency, but we are also seeing weakness in the stock market, relative weakness in the stock market, despite many people calling for a bottom and recovery in the new year. So I think this is now rupee market also probably gets into some sort of a rangy move, unless some surprise thing happens. For me, surprise will be on more on the positive side. If the trade deal happens, or if I turn positive for India with the real flows, and if these do not happen, and definitely then without RBI stepping in, gradual move once again towards 91 is a certainty. But as of now, we keep our options open. Thank you.
Thank you so much, Jairam. So, and just to summarize, the inflation data we received from the US was quite a bit of a surprise, both on the core and headline side. And the reliability can be questioned due to the shutdown of this data. And the market just wants to wait for the official data for the month of September, which will be released in Jan, which will come before, everybody's waiting for this official data before they can actually form an opinion on the rate cuts for the Fed. We also had the manufacturing survey data, which showed a big decline, indicating a concern about the downbeat manufacturing activity in the US recently. And as discussed yesterday as well, and with no surprise, the ECB maintains the rates stable and the Bank of England cuts its rates. But the markets took the Bank of England statement to be a little bit on the dovish side. And of course, the Bank of Japan is tilted towards a rate hike this morning. And not much major yen strength to be seen after this rate cut. But we also saw the Nikkei correct recently. And we can see USD JPY go up on the higher side. And when it comes to the rupee on the domestic side, it stayed quiet yesterday. So it'll be interesting to see whether the stabilization continues today. And we can take this period of quiet calmness for the next 10 days before the New Year storm begins. So yeah, we'll catch up on Monday for a fresh round of updates. Thank you all so much for listening.